Before we dive in, please remember that the information in this video is for educational and informational purposes only. I am not a financial advisor, and this presentation is not a substitute for professional financial advice. Always consult with a qualified professional before making any major financial decisions. Your financial situation is unique, and the mortgage market is complex and ever-changing. There's a moment of pure dread that thousands of Americans are feeling right now, maybe even you. It's the moment you've been working towards for years. You saved the down payment, you polished your credit score, you found the house, the one with the right-sized yard and the kitchen that gets the morning sun. You're excited, you're ready. You call your lender, and they hit you with the number, the mortgage rate. And in an instant, that dream home feels like a financial prison. The monthly payment they quote you is hundreds of dollars more than you expected just a few months ago. Your stomach sinks. You start questioning everything. Can we afford this? Should we wait? Is the American dream of homeownership slipping through my fingers? That feeling of helplessness, of being a victim to a number that seems to fall from the sky, is exactly why this video exists. Because I'm going to tell you something the mainstream news won't. The daily mortgage rate you see plastered on websites and news tickers is one of the most misunderstood, and frankly, most misleading numbers in all of personal finance. It's a symptom, not the disease. And focusing on it is like trying to predict a hurricane by looking at a single raindrop. It tells you nothing about the storm that's coming or how to prepare for it. For the next few minutes, we are going to pull back the curtain. We are going to ignore the noise, ignore the fear-mongering headlines, and build a foundational understanding of what is really driving the cost of your mortgage. This isn't just about data. It's about giving you back control. By the end of this video, you will understand the forces moving these rates better than 99% of prospective homebuyers. You won't just see the rate, you'll understand the why behind it. You'll be able to look at economic news and know, with confidence, whether it's good or bad for your potential mortgage. You'll learn to spot the trends before they happen, giving you the power to lock in your rate at the right moment. A decision that could save you tens, even hundreds of thousands of dollars over the life of your loan. This is your masterclass in navigating the single biggest financial decision of your life. So let's start at the very beginning. Where do these mortgage rates even come from? Most people think the Federal Reserve just sets them. They hear on the news, the Fed raised rates, and they assume that directly translates to their mortgage. That is flat out wrong. The Federal Reserve sets something called the Fed funds rate, which is an overnight lending rate for banks. It influences things like credit cards and car loans, but its direct impact on a 30-year fixed mortgage is minimal, almost indirect. Think of it like this. The Fed controls the temperature of the water at the beach, but your mortgage rate is the size of the waves. The temperature has some effect, sure, but the real drivers of the waves are the wind and the tides, completely different forces. So what are the real forces? The biggest indicator, the one that mortgage rates follow most closely, is the yield on the 10-year Treasury bond. Now don't let your eyes glaze over. This is simple. A Treasury bond is just a loan you give to the US government. They promise to pay you back in 10 years, and along the way they pay you interest. That interest is called the yield. This yield is considered the safest investment on planet Earth. It's the benchmark for all other long-term risk. So, when a bank is about to lend you hundreds of thousands of dollars for 30 years to buy a house, what do you think they use as their starting point for what to charge you? They look at the safest 10-year investment in the world, the 10-year Treasury yield, and then they add a bit on top for the extra risk they're taking on you. That's it. That's the basic formula. As the 10-year Treasury yield goes up, mortgage rates go up. As it goes down, mortgage rates go down. They move in lockstep like dance partners. But wait, I said we were going to go deeper than 99% of people, right? So here's the next level. While the 10-year Treasury is a great general indicator, the thing that directly controls mortgage pricing is an instrument most people have never even heard of, mortgage-backed securities or MBS. This is the holy grail. This is the secret sauce. Imagine all the mortgages in the country, yours, your neighbors, everyone's, are bundled together into a giant pool. Wall Street then chops up that giant pool of mortgage payments into tiny little pieces and sells them as a bond like a stock. That is a mortgage-backed security. Investors all over the world buy and sell these MBS all day long. Every single day the market is open. And the price of that MBS bond is what determines the rate you get from your lender that day. Here is the single most important rule you need to know. The relationship between MBS prices and your interest rate is a seesaw. It's inverse. When MBS prices go up, your interest rate goes down. Let me repeat that because it's critical. When investors are paying more for these mortgage bonds, When the price of MBS is high, lenders can offer you a lower, better interest rate. When investors get scared and start selling off these bonds, the MBS price goes down, and your interest rate goes up. It's a direct, immediate connection. The daily rate you are quoted is a direct reflection of what is happening in the MBS market, minute by minute. Think about it like the stock market. You wouldn't buy a stock just by looking at today's price, would you? Of course not. You'd look at the chart. You'd see if it's trending up or down. You'd look for patterns. You'd want to understand what news is causing the price to move. The MBS market is exactly the same. It's a living, breathing thing that reacts to economic news. So, when you hear a big piece of economic data is coming out like the inflation report, the consumer price index or CPI, or the monthly jobs report, what's really happening? Traders in New York, Chicago, and London are sitting on the edge of their seats, ready to buy or sell billions of dollars in MBS based on that number. If the inflation number comes in hotter than expected, it's bad for bonds. Investors sell, MBS prices plummet, and within minutes, lenders across the country are raising their rates. If the jobs report shows a weakening economy, that's usually good for bonds. Investors buy, MBS prices rally, and lenders start dropping their rates. This is the game behind the game. It's not some random number generator. It's a battlefield of economic data, and every report is a new skirmish that pushes and pulls on the price of these mortgage bonds, which in turn dictates the cost of your American dream. You've been looking at the scoreboard, the final rate, without ever understanding the rules of the game or what makes the score change. From this moment forward, that changes. You are no longer a spectator. You are an analyst. You now know to watch the 10-year Treasury as your guide and the MBS market as your truth. So, the big question becomes, what are the specific pieces of news that move these markets? What are the major economic reports you should be putting on your calendar? And how does the Federal Reserve, the giant in the room, use its influence to manipulate investor sentiment and steer this entire ship? Understanding that is how you go from being reactive to being predictive. That's how you spot the bottom. That's how you know when to lock your rate. And that's exactly where we're going next. The entity at the helm of this giant economic vessel, the one with its hands firmly on the levers of financial power, is the Federal Reserve. Now, before your eyes glaze over, this isn't going to be a boring economics lecture. Think of the Fed less like a stuffy government agency and more like the most powerful and often misunderstood character in this entire story. Their actions, their words, and even their silences dictate the weather in which your mortgage application lives or dies. The Fed operates under what's called a dual mandate, a mission given to them by Congress. It's deceptively simple. First, to achieve maximum employment, and second, to maintain stable prices. In plain English, they want everyone who wants a job to have one, and they don't want the price of a gallon of milk to double overnight. For decades, that second part, stable prices, wasn't a huge problem. Inflation was like a dormant volcano, but then the pandemic hit. The global economy shut down. To prevent a complete collapse, the Fed did what it's designed to do in a crisis. It opened the floodgates. They slashed their primary tool, the federal funds rate, to zero. This is the interest rate at which banks lend to each other overnight. It's the foundational rate for the entire financial system. When it's at zero, it's like giving the economy a massive shot of adrenaline. Borrowing becomes virtually free for the big players, which is supposed to trickle down and encourage spending, investment, and hiring. But they didn't stop there. They also started a massive program of quantitative easing, or QE. This is a fancy term for printing digital money and using it to buy up assets like treasury bonds and, crucially for us, mortgage-backed securities or MBS. Every month, they were buying tens of billions of dollars worth of these things. Now, why does that matter to you? A mortgage-backed security is essentially a big bundle of individual home loans, packaged together and sold to investors. The interest rate on that bundle is what ultimately determines the rate you get from your lender. When the Fed becomes the single biggest buyer of MBS in the world, they create enormous demand. Basic economics, when demand goes way up, the price goes up. And for a bond-like asset such as an MBS, when the price goes up, the yield or the interest rate goes down. So you had a double whammy working to push mortgage rates to the floor. The Fed funds rate was at zero, making all borrowing cheaper, and the Fed was gobbling up MBS like Pac-Man, artificially forcing mortgage rates into the twos. This was the era of the free money refinance boom. It was a party, but like all parties, it created a huge mess. All that cheap money flooding the system, combined with broken supply chains and a surge in consumer demand, woke up the dormant volcano. Inflation roared back to life, hitting 40-year highs. the price of everything started to skyrocket. The Fed suddenly had to slam on the brakes to honor the second part of its mandate: stable prices. The party was over, and the hangover was going to be brutal. So, how does the Fed fight inflation? It does the exact opposite of what it did during the crisis. It weaponizes interest rates. Starting in March of 2022, the Federal Reserve began the most aggressive rate hiking cycle in modern history. They jacked up that federal funds rate from 0 to over 5% in about 18 months. Each hike was a signal to the entire economy: borrowing is about to get much more expensive. This is where a critical misunderstanding happens. People hear the Fed raised rates, and they assume the Fed directly sets their 30-year mortgage rate. They don't. The Fed doesn't have a big dial on the wall that says, mortgage rates. Remember, mortgage rates are primarily tied to the bond market, specifically the yield on the 10-year Treasury note and the market for mortgage-backed securities. So what's the connection? It's about sentiment and expectation. When the Fed raises the short-term federal funds rate, it signals to investors that the central bank is serious about fighting inflation. This makes investors demand a higher return, a higher yield, on long-term investments like the 10-year Treasury to compensate for the risk of inflation eroding their profits. Since the 10-year Treasury is seen as the benchmark for risk-free long-term investment, mortgage rates tend to follow its lead. If the 10-year yield goes up, mortgage rates almost always go up with it. It's like watching two dancers moving in near-perfect sync. But the Fed had another, more direct and more powerful weapon to deploy against the housing market. They flipped the switch from quantitative easing to quantitative tightening, or QT. Instead of buying billions in mortgage-backed securities every month, they started letting them mature and roll off their balance sheet. They effectively went from being the biggest buyer in the market to a seller, or at the very least, a ghost. Think about what this does. The single biggest source of demand for MBS vanished. All of a sudden, there's a massive supply of these mortgage bonds on the market, and not enough private investors to soak them all up. So what has to happen? The price of those bonds has to fall to attract new buyers. And remember our rule: when the price of a bond goes down, its yield, the interest rate, goes up sharply. This is the 1-2 punch that sent mortgage rates from the 2s and 3s to the 7s and 8s. First, the Fed's aggressive rate hike spooked the bond market, sending the 10-year Treasury yield soaring. Second, their quantitative tightening program directly flooded the market with MBS, forcing those specific rates even higher. They were no longer just tapping the brakes. They were dropping an anchor out the back of a speeding car. The goal was to make borrowing so expensive that it would cool down demand across the entire economy, especially in the interest rate-sensitive housing market. They wanted to slow things down enough to let supply catch up and bring inflation back down to their target of 2%. It's a blunt instrument. It's like performing surgery with a sledgehammer. It causes a lot of collateral damage, namely crushing housing affordability for millions of Americans. So now we understand the who, the Fed, and the what, their tools like the Fed funds rate and quantitative tightening. We see how their war on inflation became a war on affordability. They created the party with cheap money, and then they were forced to become the police and shut it down in the most dramatic way possible. This brings us to the most important question for anyone watching this right now. What makes them stop? What signals are they looking for to declare victory and begin to reverse course? Because the moment they even hint at a change in direction, the entire market will react instantly. Rates could drop 50 basis points or 0.5% in a single day on just a few choice words from the Fed chairman. The Fed isn't driving blind. They are obsessively watching a handful of key economic reports. These reports are the dashboard for the entire U.S. economy. They are the vital signs that tell the Fed whether the patient is getting better or worse. Understanding which numbers matter most and what the Fed is looking for in those numbers is the closest thing we have to a crystal ball. It's how you can see the turn before it happens. It's how you separate the signal from the noise. And learning to read that dashboard is precisely what we're going to do next. So let's pop the hood on this dashboard. The first gauge, the biggest, brightest, most important dial on the entire panel, is the Consumer Price Index, or the CPI. This report comes out once a month from the Bureau of Labor Statistics, and on that morning, every trader in the world holds their breath. The CPI is, in the simplest terms, the nation's report card on inflation. It measures the average change over time in the prices paid by urban consumers for a market basket of goods and services. Think of it as the country's grocery bill. It tracks everything from gasoline and rent to the price of a gallon of milk and a movie ticket. Now, why does this one number have the power to swing mortgage rates by 1/4 of a point in a single morning? Because of the Federal Reserve. The Fed has two main jobs, what they call their dual mandate: maintaining price stability and maximizing employment. Price stability is just a fancy way of saying keep inflation under control. Their stated target is 2% inflation. So, when the CPI report comes out and shows inflation running hot, say at 4 or 5%, a siren goes off at the Federal. It tells them they need to keep their foot on the brake. They need to keep interest rates high to cool down the economy, to make borrowing more expensive, which slows down spending and eventually brings prices back down. A high CPI number is kryptonite for mortgage rates. Conversely, if the CPI comes in low, showing that inflation is cooling off and heading back towards that 2% target, it's a green light for the Federal. It gives them the justification they might need to start cutting interest rates, to take their foot off the brake and let the economy breathe a little. A low CPI number is rocket fuel for lower mortgage rates. But here's where it gets interesting, because not all CPI numbers are created equal. When you see the news flash a big headline, they're usually talking about headline CPI. That includes everything, including the two most volatile components, food and energy. The problem is, gas prices can spike because of a war on the other side of the world, which has very little to do with the underlying health of the US economy. That's why the Fed, and the serious market analysts, pay much closer attention to something called core CPI. Core CPI strips out food and energy. It looks at the stickier parts of inflation, things like rent, medical care, and car insurance. These prices don't jump around day to day. They reflect deeper, more systemic price pressures in the economy. Core CPI is what tells the Fed if their policies are actually working. So, you can have a situation where the headline number looks scary because of gas prices, but the core number is actually behaving quite well. That's a nuance the market understands, and it's why you have to look past the headline. The final piece of the CPI puzzle is the most important for predicting the immediate market reaction: the consensus estimate. Before the report is released, economists at all the big Wall Street banks publish their predictions. The market then bakes these expectations into prices. So, the actual market-moving event isn't the number itself, but how the number compares to what everyone thought it was going to be. If inflation was expected to be 3.5% and it comes in at 3.4%, that's a huge win. Mortgage rates will likely fall, even though inflation is still well above the Fed's target. It's better than feared. But if the estimate was 3.5% and it comes in at 3.6%, watch out. That's a disappointment, a sign that the inflation fight is harder than we thought, and rates will almost certainly spike. The entire game is about reality versus expectations. Okay, so that's the first gauge, inflation. Now let's look at the second, which is tied to the Fed's other job: maximizing employment. This is the monthly jobs report, officially known as the Employment Situation Summary. If CPI is the nation's report card on inflation, the jobs report is its physical exam. It tells us how healthy the labor market is. There are three key numbers to watch here. First is the big one everyone talks about: non-farm payrolls. This is simply how many jobs were added or lost in the previous month. A huge number, like 300,000 new jobs, suggests the economy is running hot. That's great for workers, but it can make the Fed nervous about inflation. A strong economy means people have money to spend, which can push prices up. So, paradoxically, a blockbuster jobs number is often bad for mortgage rates. A weak number, on the other hand, suggests the economy is slowing down, which reduces inflation fears and gives the Fed room to cut rates. The second number is the unemployment rate. This one is pretty straightforward. A low unemployment rate is generally good, but if it gets too low, it can lead to the third and most critical number: average hourly earnings. This is wage growth, and this is the one that can keep members of the Federal Reserve up at night. If jobs are plentiful and workers are scarce, companies have to compete for them by offering higher and higher wages. When people earn more, they spend more. This can create something economists call a wage price spiral. Higher wages lead to higher prices, which lead to demands for even higher wages, and on and on. It's a vicious cycle that is incredibly difficult for a central bank to break. So, when the jobs report comes out, the bond market looks straight at that wage growth number. If it's hotter than expected, it's a major red flag for inflation, and a bad sign for mortgage rates. If wage growth is cooling, it's a sign that the labor market is coming back into balance, and it's a huge sigh of relief for the Fed. So you have CPI telling you what things cost, and the jobs report telling you how much money people have to spend. They are two sides of the same economic coin. But there's one more report, a sort of sleeper agent on the dashboard that you won't hear as much about on the nightly news, but it's arguably the most important of all. It's called the Personal Consumption Expenditures Price Index, or PCE. This is another measure of inflation, but with a few key differences from the CPI. The most important difference is that PCE is the Federal Reserve's official, preferred gauge of inflation. Their 2% target isn't technically based on CPI. It's based on core PCE. Why do they prefer it? In short, it's smarter. The CPI measures a fixed basket of goods. If the price of steak goes up, the CPI just records that steak is more expensive. The PCE, however, accounts for substitution. It recognizes that if steak gets too expensive, people will buy more chicken instead. It dynamically adjusts its basket to reflect how consumers are actually behaving, making it a more accurate, real-world measure of the cost of living. Because this is the Fed's own benchmark, the monthly PCE report can sometimes have an even bigger impact on their thinking than the more famous CPI. It's the insider's number. When you hear a Fed official talk about making progress on inflation, they are thinking about PCE. So let's put it all together. Reading this dashboard isn't about looking at one number in isolation. It's about understanding the story these numbers tell together. It's like a doctor diagnosing a patient. CPI is the temperature. Is the economy running hot? The jobs report is the pulse and blood pressure. How strong and resilient is it? And PCE is the detailed lab work, the specific test result that the specialist, the Fed, is going to base their treatment plan on. By tracking these three reports month after month, you can stop reacting to headlines and start anticipating the moves. You see the trend, not just the daily noise. You understand the why behind rate movements, not just the what. We've learned to read the monthly report card. But what happens in the 29 days in between? That's when the real game is played. It's where you find the daily volatility, the subtle whispers from the bond market, and the coded language of the Federal Reserve itself. And cracking that code, well, that's where the pros separate themselves from the amateurs. So let's pull back the curtain. The first and most critical thing you have to understand is that the Federal Reserve does not set your mortgage rate. Let me say that again because it is the single most misunderstood concept in all of personal finance. The Federal Reserve does not set your mortgage rate. What they set is the federal funds rate. That's the overnight lending rate for banks. It's a foundational piece of the economy for sure. Think of it like the wholesale price of sugar for a candy factory. It influences the final price of a lollipop, but it's not the only ingredient. The price of chocolate, the cost of the wrapper, the wages for the workers, the rent on the factory, all of that matters too. The mortgage market is the same way. The Fed funds rate is just one ingredient, and frankly, it's not even the most important one for long-term loans like a 30-year fixed mortgage. The real puppeteer, the force that pulls the strings on your mortgage rate every single day, is the bond market. Specifically, two key players, the 10-year Treasury note and a little thing called the mortgage-backed security, or MBS. Let's start with the 10-year Treasury. Think of it as the North Star for all long-term debt in the United States. It's a loan that you, an investor, give to the U.S. government for a period of 10 years, and they pay you interest. The interest rate on that loan is called the yield. Because the U.S. government is considered the safest borrower on the planet, the yield on its 10-year note becomes the benchmark, the baseline risk-free rate of return. Any other long-term loan, like a 30-year mortgage, has to offer a higher interest rate to be attractive, because it's inherently riskier than lending to Uncle Sam. So, as a general rule, when the 10-year Treasury yield goes up, mortgage rates follow. When it goes down, mortgage rates tend to fall as well. They move in a clumsy but undeniable dance together. Now here's the part that trips people up. Bond prices and bond yields have an inverse relationship. They move in opposite directions like two kids on a seesaw. When investors are scared and rushing to buy safe haven bonds, the high demand pushes the price of the bond up. And when the price goes up, the yield, the effective interest rate, goes down. Conversely, when investors are optimistic about the economy or worried about inflation, they sell bonds to put their money into riskier, higher return assets like stocks. This flood of selling pushes the bond price down, which causes the yield to shoot up. So remember this simple mantra: bond prices up, rates down. Bond prices down, rates up. This is the fundamental law of gravity in the mortgage world. But the 10-year Treasury is just the benchmark. It's the weather forecast. The actual weather, the thing that's directly raining on your parade or giving you a sunny day to lock your rate, is the MBS market. This is where the magic and the madness truly happens. What is a mortgage-backed security? Lenders don't just hold onto your 30-year mortgage for 3 decades. That would be incredibly inefficient. Instead, they act like a smoothie shop. They take your mortgage, my mortgage, and thousands of other mortgages with similar characteristics, and they blend them all together into one giant financial smoothie. This smoothie is then packaged up and sold to investors on Wall Street, pension funds, insurance companies, foreign governments, as a mortgage-backed security. The investors who buy the MBS get to collect the monthly principal and interest payments from all of us homeowners. This is the direct mechanical link. The interest rate your lender offers you is almost entirely determined by the price investors are willing to pay for that MBS smoothie on any given day. If investors are feeling confident and are clamoring to buy MBS, they'll pay a high price for them. This means the lender doesn't have to offer as high of an interest rate on the underlying mortgages to make the smoothie attractive. The result? You get a lower rate. But what happens when investors get spooked? Let's say a scary inflation report comes out. Investors now worry that the value of those fixed monthly payments will be eroded by rising prices. They also worry the Fed will raise short-term rates, making their older, lower-yielding MBS look like yesterday's news. So they start selling. The price of MBS plummets. In order for the lender to create a new MBS smoothie that anyone will actually want to buy in this new fearful environment, they have to pack it with mortgages that have a much higher interest rate. The result? Your rate goes up. Instantly. This isn't a process that happens over weeks. It happens in minutes. Let me walk you through a hypothetical day. It's 8:30 a.m. Eastern Time. The monthly jobs report is released. The number is a blockbuster. Way more jobs were created than anyone expected. On the surface, that sounds like great news, right? A strong economy. But to the bond market, it's a horror film. A super strong jobs report means more wage pressure, which means more inflation. And inflation is the kryptonite of the bond market. Within seconds, algorithms and human traders start dumping bonds. They are selling 10-year treasuries. They are selling mortgage-backed securities. The screen is a sea of red. Bond prices are cratering. As prices fall, yields skyrocket. The yield on the 10-year treasury might jump from 4.2% to 4.35% in the span of 15 minutes. Your loan officer, who quoted you a great rate at 8:15 a.m., is now staring at their screen in terror. Their pricing engine, which is linked directly to the live MBS market, is flashing red alerts. The cost of money just went up dramatically. The bank's secondary marketing department issues an immediate memo. Negative reprice in effect. All previous rate sheets are invalid. The rate that was 6.75% a few minutes ago is now 7%. And just like that, because of a single data point in an economic report, your potential monthly payment just jumped by hundreds of dollars. That's the daily volatility. That's the real game. This is also where the Fed's coded language comes in. The Fed chair gives a speech. He's talking about the economy, and he uses the word resilient to describe consumer spending. The market was hoping he'd use a word like softening. That one word, resilient, is interpreted as hawkish. It's a signal that the Fed sees no reason to cut rates anytime soon. Bond traders hear that word and the selling begins all over again. Prices down, rates up. Conversely, if he uses a dovish word, suggesting concern about a slowing economy, traders will start buying bonds, anticipating future rate cuts. Prices up, rates down. Every single word is parsed and analyzed, triggering billions of dollars in trades that directly impact the rate you are offered on your home loan. You don't have to be a Wall Street quant to follow this. You can watch it yourself. Go to any financial website and pull up the chart for the 10-year Treasury yield. The ticker is often TNX. Watch it throughout the day. If you see that line trending sharply upward, you know with near certainty that mortgage rates are getting worse in real time. If you see it trending down, it's a good day for borrowers. It is the closest thing you have to a public-facing speedometer for mortgage rates. It's not a perfect one-to-one correlation, but it is the single most powerful indicator available to the average person. Watching the 10-year Treasury is how you start to crack the code, how you move from being a passive rate taker to an informed participant in your own financial future. So we've cracked the code of the bond market. We know how rates move. We understand the mechanics of MBS pricing and the seesaw of bond prices and yields. But the billion-dollar question remains. Why do they move? What are the specific triggers, the economic reports like the jobs data or the inflation numbers that land like bombshells every month, sending traders scrambling and your potential mortgage payment soaring or sinking in a matter of minutes? Understanding these reports, that's the final key to truly timing the market. So let's pull back the curtain on this high-stakes data game. You have 3 main events, 3 heavyweight championship fights that happen every single month. Get these right, and you're no longer a passenger in your home buying journey. You're in the co-pilot seat. These are the Consumer Price Index, or CPI, the Producer Price Index, or PPI, and the big one, the Monthly Jobs Report. Let's start with the headliner, the one that gets all the press, the CPI. The Consumer Price Index is, in the simplest terms, the nation's report card on inflation. The government essentially goes shopping for a massive theoretical basket of goods and services. This isn't just a few things, we're talking about everything from the price of eggs and gasoline to rent, airfare, car insurance, and even your doctor's visit. They add it all up and compare the total cost to what it was last month and what it was last year. The percentage change. That's the inflation rate you hear about on the news. Now, here's where the pros separate themselves from the amateurs. You'll hear 2 numbers: headline CPI and core CPI. Headline includes everything, even the notoriously volatile prices of food and energy. One pipeline issue or a drought can send those prices soaring, but it might not reflect the true underlying trend. That's why the Federal Reserve, and by extension the bond market, pays obsessive attention to core CPI. Core CPI strips out food and energy to get a clearer picture of the sticky, more persistent inflation baked into the economy. The CPI report drops like a bomb at 8:30 a.m. Eastern Time, usually around the middle of the month. In the seconds before that release, you can feel the tension in the market. Traders are poised, algorithms are humming. Then the number hits. The market cares about one thing and one thing only. Was the number hotter or cooler than expected? The actual number almost doesn't matter as much as how it compares to the consensus forecast. What a bunch of economists predicted it would be. If CPI comes in hot, higher than expected, it's a 5-alarm fire for the bond market. It screams that inflation isn't under control. It signals that the Federal Reserve might have to keep interest rates higher for longer, or even hike them again. In response, traders dump bonds with lightning speed. When bond prices fall, their yields, their interest rates go up. And remember our golden rule. The 10-year Treasury yield is the North Star for mortgage rates. So a hot CPI report at 8:30 a.m. can mean the mortgage rate your lender quoted you at 8:29 a.m. is already gone. It's that fast. Conversely, if CPI comes in cool, lower than expected, the market breathes a collective sigh of relief. It's a sign that the Fed's policies are working, that the inflation beast is being tamed. This gives the Fed room to consider cutting rates in the future. Traders pile into bonds, pushing their prices up and their yields down. Your potential mortgage rate just got a little bit better. This is the whole game. Expectation versus reality. Next up is the CPI's often overlooked sibling, the Producer Price Index, or PPI. If CPI is the price you pay at the checkout counter, PPI is the price the store paid to get the product on the shelf in the first place. It measures the change in selling prices for domestic producers. Think of it as wholesale inflation. It tracks the cost for raw materials manufacturing and all the intermediate steps before a product ever gets to you. Why does this matter? Because it's a crystal ball. The PPI is a leading indicator for the CPI. If a company that makes furniture is suddenly paying more for wood, steel, and shipping, it's a pretty safe bet that they're going to pass those higher costs on to you in the near future. The couch you want to buy is going to get more expensive. The PPI report usually comes out a day or two after the CPI, and while it doesn't create the same immediate fireworks, the market watches it very, very closely. A surprisingly hot PPI report plants a seed of fear. It tells investors, watch out. Next month's CPI might be ugly. It's the rumble of thunder in the distance, warning of a potential storm. A cool PPI, on the other hand, provides comfort, suggesting that inflationary pressures are easing at the source. It gives the market hope that future CPI reports will also be cool, creating a positive feedback loop that can gently nudge mortgage rates lower. And that brings us to the most powerful and, frankly, the most misunderstood report of them all, the Monthly Jobs Report, officially known as the Non-Farm Payrolls Report. This report lands on the first Friday of every month, again at 8:30 a.m. Eastern, and it can single-handedly set the market's tone for the entire month. It answers 2 main questions. How many jobs did the U.S. economy add or lose last month? And what is the unemployment rate? Now, here is the paradox that trips everyone up. Your entire life, you've been taught that a strong jobs report is fantastic news. Lots of jobs being created, low unemployment, that means the economy is booming, right? And yes, for the country it is. But for mortgage rates, it's often terrible news. Think about it from the Federal Reserve's perspective. Their number one enemy is inflation. What fuels inflation? An economy that's running too hot. If millions of people are getting new jobs and big raises, they have more money to spend. They go out and buy more cars, more houses, more vacations. This increased demand pushes prices up across the board. A red-hot labor market is inflationary fuel. So when a jobs report comes out and shows the economy added way more jobs than anyone expected, the bond market panics. It's a signal that the Fed can't possibly think about cutting interest rates. In fact, it might make them even more aggressive. Traders sell bonds, yields spike, and mortgage rates shoot up. We saw this happen repeatedly over the last 2 years. A blockbuster jobs number would be released, and mortgage rates would have their worst day of the month. The flip side is also true. A weaker-than-expected jobs report, while seemingly bad news for the economy, is music to the bond market's ears. It suggests the economy is cooling down, that demand is waning, and that inflation will likely follow suit. This gives the Fed the green light to ease off the brakes, to consider future rate cuts. Bond yields fall and mortgage rates improve. It's a bizarre world where you, the prospective homebuyer, are secretly rooting for slightly bad economic news. You don't want a recession, but you're hoping for just enough of a slowdown to convince the Fed to give you a break. Inside that jobs report, the market also dissects a number called average hourly earnings. This is wage inflation. If people are getting paid more per hour, that's one of the stickiest forms of inflation, and it makes the Fed extremely nervous. A jobs report with strong job growth and rapidly rising wages is the ultimate nightmare scenario for mortgage rates. So you have this trio of data points painting a monthly picture. The jobs report tells you about the health of the consumer and the heat in the labor market. The PPI gives you a sneak peek at wholesale price pressures. And the CPI gives you the final all-important verdict on consumer inflation. Together, they are the primary clues the Federal Reserve uses to solve the puzzle of the economy and decide where interest rates need to go next. And by understanding how the market reacts not just to the news, but to the surprise in the news, you can finally anticipate the daily swings in mortgage rates instead of just being a victim of them. You can start to see the patterns to understand the rhythm of the market and to make your move not out of panic but with strategy. And that strategy begins with understanding the three titans that move the mortgage market. The three heavyweight champions whose every move sends shockwaves through your potential monthly payment. Think of them as the main characters in this drama. First, you have the jobs report. This is the big one, the monthly blockbuster. It tells us how many jobs were created or lost, what the unemployment rate is, and crucially, how much wages are growing. It's the single most powerful snapshot of the health of the American economy. Second, you have the inflation report, officially known as the CPI, or Consumer Price Index. This is the villain of our story right now. It measures how much the price of everyday goods and services, from a gallon of milk to a gallon of gas, is changing. When inflation is high, it's like a dragon breathing fire on the economy, and the Federal Reserve is the knight tasked with slaying it. And that brings us to our third titan, the Fed itself. The Federal Reserve. They are the ultimate authority, the ones who set the key interest rate that influences everything else, including mortgages. But here's the secret. The Fed doesn't operate in a vacuum. They are constantly watching the other two titans. They are obsessed with the jobs report and the inflation report. Those two reports are the tea leaves the Fed reads to decide its next move. So, you have the jobs report, the inflation report, and the Fed's reaction to them. That's the golden triangle. Everything else is just noise. Your job, as a strategic homebuyer, is not to become a PhD economist. It's to become an expert at watching these three characters and understanding how they interact. Let's make this real. Let's walk through a recent classic example of this drama playing out. A scenario that left thousands of homebuyers either celebrating or tearing their hair out, all in the space of about 15 minutes. Picture this. It's the first Friday of the month, 8:30 a.m. Eastern Time. The entire financial world is holding its breath. This is the moment the jobs report is released. For weeks, economists, analysts, and every trader on Wall Street have been making their predictions. The consensus forecast, the expected number, is that the economy added, let's say, 180,000 jobs. Now, why does this matter for your mortgage? Because of the bond market. Mortgage rates aren't set by your local bank manager's mood. They are tied to the price of mortgage-backed securities, or MBS, which are a type of bond. When the economy looks strong, investors worry about inflation, so they sell bonds. When they sell bonds, the price goes down and the interest rate or yield goes up. And that up yield translates directly to a higher mortgage rate for you. Conversely, if the economy looks weak, investors flock to the safety of bonds, buying them up. Bond prices go up, yields go down, and your mortgage rate gets cheaper. So back to 8:30 a.m. The entire market is betting on 180,000 jobs. A number right around there would be a Goldilocks scenario. Not too hot, not too cold. It would suggest the economy is stable but not overheating, which would keep the Fed on a predictable path and mortgage rates relatively calm. But then the number drops. 8:30 a.m. hits and the screen flashes. The number isn't 180,000. It's 300,000. An absolute blockbuster. A blowout number. On the surface, this is fantastic news, right? The media headlines will scream booming job market. Economy soars. Your uncle at the family barbecue will say, see? Everything's great. But in the cold, calculated world of mortgage rates, this fantastic news is a catastrophe. Within seconds, not minutes, seconds, the bond market reacts. Traders see 300,000 jobs and they don't see a healthy economy. They see an economy on fire. They see wage growth that will push inflation higher. They see a Federal Reserve that now has absolutely no reason to even think about cutting interest rates. In fact, they might even consider hiking them again. The reaction is violent and immediate. A tidal wave of selling hits the bond market. Everyone is dumping bonds. The price of MBS plummets like a stone. And as the price falls, the yield, your mortgage rate skyrockets. A mortgage rate that was 6.875% at 8:29 a.m. is suddenly 7.125% by 8:35 a.m. A quarter-point jump in 6 minutes. For someone trying to lock in their rate on a $400,000 loan, that's a difference of over $60 a month, more than $21,000 over the life of the loan, vanished into thin air because of a single data point. This is the most critical and counterintuitive lesson you must learn. In the current economic environment, good news for the economy is often bad news for your mortgage rate. Let me say that again because it's the key to the entire kingdom. Strong economic news like a blockbuster jobs report or higher than expected inflation signals that the Fed will have to keep interest rates higher for longer to cool things down. And that sends mortgage rates soaring. Conversely, bad economic news, a weaker than expected jobs report, slowing wage growth, a drop in consumer spending, is actually fantastic news for your mortgage rate. When traders see those weak numbers, they think, aha, the economy is slowing down. The Fed's rate hikes are finally working. Inflation is going to cool off. And the Fed will be forced to cut rates soon to prevent a recession. So what do? They rush to buy bonds, anticipating that future rate cut. Bond prices surge, yields fall, and mortgage rates improve. You have to completely rewire your brain. You have to learn to watch the evening news, see a report about a surprisingly strong economy, and your first thought shouldn't be great. It should be, oh no, rates are probably going up tomorrow. You need to see a headline about slowing retail sales and think, okay, this could be the opening I've been waiting for. This isn't about rooting against the economy. It's about understanding the cause and effect relationship that governs the market you're about to enter. The market isn't emotional. It's a cold, odds-making machine constantly placing bets on what the Federal Reserve will do next. And the jobs report and the inflation report are the two most important cards turned over in this high-stakes poker game. So how do you use this? You start tracking the dates. You put the first Friday of every month on your calendar. That's Jobs Day. You find out when the next CPI report is coming out. You can Google economic calendar and find dozens of free resources. You don't need to read the 200-page report. You just need to know two things. What was the forecast number, and what was the actual number? If the actual number for jobs or inflation comes in way hotter than the forecast, you can predict with near certainty that rates will worsen. If it comes in way cooler, you can expect an improvement. If it's right around the forecast, the market will likely shrug, and rates will stay flat. This is how you move from being a passenger to being the pilot. When your loan officer calls and says, rates are looking pretty good today, you should probably lock. You can now ask a smarter question. You can say, hold on, the CPI report comes out tomorrow morning at 8:30. The forecast is for a slight decrease. I think I'll take my chances and float my rate overnight. If the report comes in soft, we could see a nice dip and I'll lock then. If it comes in hot, I'll be ready to lock immediately before the damage gets worse. Look at the difference. That is a conversation of power. That is a conversation of strategy. You are no longer just reacting to the market. You are anticipating its moves based on the same data the professionals are watching. You are using the market's own rhythm to your advantage. timing your single biggest financial decision around the predictable release of market-moving information. This knowledge, this simple understanding of the three titans, is the first and most powerful weapon in your arsenal. It transforms you from a pawn in the game to a player. But this is just the data that everyone sees, the front page news. What about the signals that are harder to spot? These are the signals that separate the informed from the inundated. The first, and perhaps most infamous, is a ghost that haunts the financial markets. It's called the yield curve inversion. Now, you've probably heard this term thrown around on financial news, usually followed by the scary word recession. And for good reason. It has predicted every single US recession since the 1950s. But for our purposes, for understanding your future mortgage payment, what it truly signals is fear. Think of it this way. Normally, if you lend someone money for a longer period, you expect a higher interest rate to compensate you for the risk over that time. A 10-year loan should have a higher yield than a 2-year loan. That's a normal, healthy yield curve. It slopes upward. But when investors get scared about the long-term future of the economy, a strange thing happens. They pile into long-term bonds like the 10-year Treasury, seeking a safe place to park their money for a long time. This massive demand pushes the price of those bonds up, which in turn pushes their yield down. At the same time, they might see the short term as risky, demanding higher yields for short-term loans. Suddenly, the curve inverts. The yield on a 2-year bond becomes higher than the yield on a 10-year bond. The market is screaming that it has more faith in the next decade than it does in the next 24 months. It's a vote of no confidence in the immediate economic future. Why does this matter for your mortgage? Because a fearful market is a volatile market. Banks get nervous. They tighten their lending standards. They start pricing in future economic weakness. An inverted yield curve is the financial markets version of a storm siren. While the three titans of data tell you what just happened, the yield curve is whispering about what's coming. It's the market's collective anxiety attack, and that anxiety almost always spills over into mortgage rates, often creating a ceiling for how high they can go before the economy breaks. The second hidden signal isn't found in a data chart, but in the carefully chosen words of a handful of people in Washington, D.C. I'm talking about Fed speak. We all watch for the headline. Did the Federal Reserve raise, lower, or hold interest rates? But the real gold is in the nuance of their language. The Fed's official statements, the press conferences, and the meeting minutes are pored over by traders word for word, like ancient scholars deciphering a sacred text. A single word change can send billions of dollars moving around the globe in seconds. For instance, for months the Fed might describe inflation as elevated. Then one day they change it to moderating. That single word is a monumental signal that their hawkish stance might be softening. Or listen to how they describe their future plans. Do they say they anticipate further rate hikes, or that they will assess the need for them? Anticipate is a promise. Assess is a maybe. That difference is worth billions. You need to become a student of their adjectives. Are they data dependent, meaning they're just reacting? Or do they have a forward-looking policy, meaning they have a set plan? Is their tone dovish, signaling a preference for lower rates to stimulate the economy? Or is it hawkish, signaling a desire to raise rates to fight inflation? When you listen to the Fed chair speak, don't just hear the decision. Listen for the justification, the adjectives, the subtle shifts in tone. That is where the market finds its clues for the next 6 months, and where you can find the clues for the future direction of your mortgage rate long before it becomes front-page news. Now for the big one, the signal that is most directly tied to your mortgage, yet almost nobody outside of Wall Street talks about it. We all follow the 10-year Treasury yield as the benchmark, and it's a great guide. But it's not what actually determines your mortgage rate. Think of the 10-year Treasury as the wholesale price of generic long-term debt. Your mortgage, however, is a very specific product. The real engine room for mortgage rates is a separate, more obscure market. The market for mortgage-backed securities, or MBS. Here's how it works in the simplest terms. Your lender gives you a loan. They then bundle your mortgage with thousands of other similar mortgages and sell it as a bond-like investment, an MBS, on Wall Street. The interest rate you pay is directly determined by the price investors are willing to pay for that MBS bond. So, the health of the MBS market is the health of the mortgage market. The secret signal here isn't the MBS yield itself, but the spread, the difference between the MBS yield and the 10-year Treasury yield. In a stable, confident market, this spread is relatively small and predictable. Investors see mortgages as only slightly riskier than a government bond, so they demand a little extra return. But when the market gets nervous about the housing market, about foreclosures, about the economy in general, investors demand a much higher premium to buy MBS. The spread widens. This is critical. You can have a situation where the 10-year Treasury yield is actually falling, which should be good news for rates. But if the MBS spread is blowing out, if it's getting wider because of fear in the housing sector, your mortgage rate could actually go up. Watching this spread is like having an EKG for the mortgage industry itself. A widening spread is a sign of stress and a warning that the rates you see advertised are about to get more expensive, regardless of what the headline Treasury yield is doing. It's the insider's indicator. Finally, there's the signal that's the most human of all: consumer sentiment. There are two big reports to watch here: the University of Michigan's Consumer Sentiment Index and the Conference Board's Consumer Confidence Index. These might seem like soft data, just surveys of how people are feeling. But don't underestimate the power of feelings in an economy that is 70% consumer spending. These indexes are a direct measure of fear and greed on Main Street. When confidence is high, people feel secure in their jobs. They spend money, they buy cars, they renovate their homes, they go out to eat. This spending fuels economic growth, but it can also fuel inflation, putting pressure on the Fed to keep rates higher. Conversely, when sentiment plummets, people get scared. They stop spending on anything but the essentials. They hoard cash. They pay down debt. This slowdown in spending can cool inflation, but it can also tip the economy into a recession. The Fed watches these numbers like a hawk because they are a powerful leading indicator. They tell the Fed where the economy is likely headed before the hard data, like the jobs report or CPI, confirms it. If you see consumer confidence fall off a cliff for several months in a row, it's a powerful signal that the economic activity is about to slow dramatically, and the pressure on the Fed to cut rates in the future is building, even if they're still hiking them today. The yield curve, Fed speak, the MBS spread, and consumer sentiment. These are the secondary indicators, the whispers to the market's shouts. They provide the context, the color, the story behind the headline numbers. By learning to read them, you're no longer just looking at a snapshot of the economy. You're watching the movie unfold, seeing the plot develop, and anticipating the next scene before everyone else in the theater. Now you can read the hidden language of the market. But reading it is one thing. Knowing exactly when to act, when to pull the trigger on your mortgage lock, that's a different skill entirely. And it depends on one critical factor that almost everyone overlooks. That critical factor is your personal risk tolerance. It's the invisible force guiding your financial decisions, and when it comes to locking your mortgage, it is everything. It's not about what the market is doing. It's about what the market's movements do to you. This is the human element in a world of algorithms and data points, and ignoring it is the fastest way to make a decision you'll regret for the next 30 years. To really understand this, let's create two characters. Let's call them Safe Play Sarah and Risk It Rick. I want you to listen closely and see which one you identify with more. First, let's talk about Sarah. Sarah values certainty above all else. The thought of her mortgage payment changing by even a few dollars from what she's budgeted for gives her anxiety. She's a planner. She has her budget in a spreadsheet. She knows exactly where every dollar is going. And the primary goal of this entire home buying process is to achieve stability. For Sarah, peace of mind is worth more than a few basis points on a loan. When her lender offers her a rate of, say, 6.75%, she looks at the monthly payment. She plugs it into her budget. It works. It's comfortable. She can sleep at night with that number. At that moment, her loan officer might say, "Well, Sarah, the Fed is meeting next week, and there's a chance rates could dip a little if the inflation report is good." For Sarah, this isn't good news. It's noise. It's uncertainty. What if the report is bad? What if rates don't dip, but spike to 7%? The potential gain of saving maybe $50 or $100 a month is completely overshadowed by the potential pain of losing a rate she knows she can already afford. So Sarah locks her rate. Immediately, she takes the 6.75% and never looks back. She's taken the risk off the table. Her home buying journey just got 100 times less stressful. The upside for Sarah is immense psychological relief. The deal is done. The number is fixed. She can now focus on packing, choosing paint colors, and everything else. She has successfully avoided the nightmare scenario of rates running away from her just before closing. But there's a downside. What if the inflation report was good? What if rates dropped to 6.5% the following week? On a $400,000 loan, that quarter-point difference is about $65 a month. It doesn't sound like a lot, but over 30 years that's over $23,000. Sarah effectively paid a $23,000 premium for peace of mind. For her it might be worth it, but it's a real cost. She left money on the table in exchange for certainty. Now let's look at the other side of the coin. Risk It Rick. Rick is different. He sees the market not as a source of anxiety, but as an opportunity. He's comfortable with volatility. He understands that with great risk comes the potential for great reward. He's not a reckless gambler, but he's willing to play the odds if he believes they're in his favor. When Rick gets that same 6.75% quote from his lender, his first thought isn't "great, I can afford this." His first thought is, "Can I do better?" He's been watching the 10-year Treasury yield. He's been listening to the economic news. He believes the market is pricing in too much bad news, and that there's a good chance for a downward correction. So Rick decides to float his rate. This means he doesn't lock it in. He is intentionally choosing to ride the waves of the market. This is an active, high-stress strategy. Every morning, Rick is checking the rate charts. He's watching the financial news. His mood for the day might literally depend on what the bond market did overnight. He has a target in mind. He tells himself, if rates hit 6.5%, I'm locking instantly. But he also has a pain threshold. If they go up to 6.9%, I'm locking to stop the bleeding. The potential upside for Rick is huge. If his timing is perfect, if he catches that dip right at the bottom, he could secure that 6.5% rate and save himself that $23,000 over the life of the loan. He'll feel like a genius. He beat the system. He took a calculated risk and it paid off handsomely. He got the same house as Sarah, but his costs him less every single month. But the downside is catastrophic. What if he gets greedy? What if rates hit 6.5% and he thinks, maybe they'll go to 6.4%, so he waits one more day. And on that day, some unexpected geopolitical event happens, or a surprisingly hot inflation report comes out. Suddenly, rates don't just go up, they skyrocket. They blow past his original 6.75% quote, past his 6.9% pain point, and settle at 7.1%. Now he's in a panic. He's forced to lock at a much higher rate, costing him over $100 more per month than his original offer. That's nearly $40,000 in extra interest over the life of the loan. His gamble didn't just fail. It backfired spectacularly. So who are you? Are you a safe play Sarah, who prioritizes certainty and a good night's sleep? Or are you a Risk It Rick, who is willing to endure the stress for a shot at a better deal? There is no right answer. I'm not telling you one is better than the other. The only mistake is not knowing which one you are before you start the process. Self-awareness here is your greatest asset. But maybe there's a third way. A hybrid approach that takes the best of both worlds. This is for the person who says, I'm mostly a Sarah, but I don't want to leave thousands on the table if I don't have to. Or the person who says, I'm a bit of a Rick, but I need a system to protect me from my own greed or panic. This is the informed floating strategy. It's based on setting clear, non-emotional boundaries before you even start. First, you define 3 numbers. Number 1 is your acceptable rate. This is the initial quote from your lender, the 6.75% in our example. You've done the math. You can afford it. If you lock this rate, you will not be disappointed. It's your baseline. Second, you define your dream rate. This is your optimistic, best-case scenario. Based on your research, maybe it's 6.5%. This is the number that, if it hits, you lock immediately without hesitation or second-guessing. No greed. You hit your target, you take the win. Third, and this is the most important, you define your panic rate. This is your absolute ceiling. The point of no return. Maybe it's 6.85%. This is the rate at which you swallow your pride, admit the market didn't go your way, and lock to prevent further damage. This trigger is non-negotiable. It's your safety net. By setting these 3 numbers in stone at the very beginning, you remove emotion from the daily decision-making process. You're no longer guessing. You have a plan. You're not just floating aimlessly. You're floating within a predefined channel. The key is to write these numbers down. Tell your loan officer. Tell your spouse. Create accountability. Because in the heat of the moment, when you see rates dropping, the temptation to get greedy is powerful. And when you see them rising, the instinct to panic is overwhelming. Your predefined plan is your anchor in that storm. This all ties back to a powerful psychological principle called loss aversion, pioneered by psychologists Daniel Kahneman and Amos Tversky. It's the concept that for humans, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels worse than finding $100 feels good. This is why most people are naturally a safe play Sarah. The fear of rates going up, a loss, is far more motivating than the hope of rates going down, a gain. Your brain is hardwired to avoid the risk. Risk it Rick is the exception, the person whose tolerance for potential loss is unusually high. Understanding this bias in yourself is critical. It allows you to step back and ask, am I making this decision based on a rational plan, or am I letting my primal fear of loss dictate my financial future? So now you understand the market's language, and you understand your own personal risk profile. You have a strategy. You're ready. But what if you've done all this? You know you're a Sarah with a plan. You have your 3 numbers set. And then, overnight, a single government report comes out and completely shatters the market? There are specific, scheduled days on the economic calendar that are absolute landmines for mortgage rates. And knowing when they are is the final piece of this high-stakes puzzle. Let's call them the 3 horsemen of the mortgage apocalypse. They are the Consumer Price Index, the Jobs Report, and the Federal Reserve's FOMC meeting. These aren't just data points, they are verdict days. They are the days when the entire financial world holds its breath, and your mortgage rate hangs in the balance. Understanding what they are, and more importantly, when they are, is like having the enemy's battle plans before the first shot is fired. First up, the big one, the monster under the bed for the last few years, the Consumer Price Index or CPI. This report is released around the middle of each month, and it is the official scorecard for inflation. Think of it like this. The government creates a theoretical shopping cart filled with hundreds of items the average American buys: gas, groceries, clothes, rent, a movie ticket. The CPI report measures how much the price of that entire cart has changed from the month before and the year before. When you hear the headline "Inflation came in hotter than expected," it means the price of that shopping cart went up more than the experts predicted. And for the Federal Reserve, whose #1 job right now is to slay the inflation dragon, a hot CPI report is a declaration of war. It's a signal that their current strategy isn't working fast enough. It's like a doctor seeing a patient's fever spike higher. What do? They increase the dosage of the medicine. In the Fed's case, the medicine is high interest rates. So, when CPI comes in hot, the bond market immediately starts pricing in the fact that the Fed will have to be more aggressive for longer. They sell bonds, yields go up, and your mortgage rate gets a gut punch, sometimes within minutes of the report's release at 8:30 a.m. Eastern Time. Conversely, if CPI comes in cooler than expected, it's a sign the fever is breaking. The market breathes a sigh of relief, betting the Fed might ease up sooner. Bonds rally, yields fall, and mortgage rates improve. Of all the monthly reports, this one has been the undisputed heavyweight champion of rate volatility. Next, we have the great paradox of the economy, the jobs report. Officially called the Employment Situation Summary, this report drops on the first Friday of every month. It tells us how many jobs were created, what the unemployment rate is, and, crucially, how much wages are growing. Now, here is the twisted logic you have to understand to master this game. A blockbuster, fantastic, amazing jobs report is often terrible news for mortgage rates. Feels completely backward, right? More people working and making more money should be a good thing. And for the country, it is. But for interest rates, it's a threat. Think about it from the Fed's perspective. What fuels inflation? Too much money chasing too few goods. If the economy adds way more jobs than expected and wages are soaring, it means millions of people have more money to spend. That spending puts upward pressure on prices for everything, pouring gasoline on the inflationary fire the Fed is trying to put out. So when that good jobs report hits, the bond market doesn't celebrate. It panics. It sells off, anticipating the Fed will see this economic strength as a reason to keep rates higher for longer to cool things down. On the other hand, a weak jobs report, one that shows the economy is slowing down, is seen as a victory in the fight against inflation. It signals that the Fed's medicine is working, and they might be able to cut rates sooner. The bond market rallies and mortgage rates fall. It's a world where bad news is good news, and good news is bad news. Welcome to the bizarre reality of interest rate forecasting. Finally, we have the main event, the Super Bowl of economic events, the Federal Open Market Committee, or FOMC meeting. This happens 8 times a year, roughly every 6 weeks. This is when the 12 leaders of the Federal Reserve get in a room, debate the state of the economy, and vote on whether to raise, lower, or hold the line on their key interest rate, the Fed funds rate. This is Judgment Day. The announcement comes out at exactly 2 p.m. Eastern Time, And for the next hour, all hell can break loose. But here's the secret the pros know. It's rarely about the actual decision itself. The market is smart. It almost always correctly predicts what the Fed is going to do with rates that day. The real action, the thing that causes massive swings, is in the language. It's in the official statement they release, and even more so, in the press conference the Fed chair holds at 2:30 p.m. Wall Street analysts, traders, and algorithms dissect every single word, every turn of phrase, every subtle pause. Did the chair say the Fed will be patient? That's a signal they're in no rush to cut rates. Did they describe inflation as moderating instead of elevated? That's a hint they're feeling more optimistic. These subtle shifts in tone are clues about what the Fed is planning to do next. It's a high-stakes poker game, and the Fed chair is trying to send a message to the market without showing their entire hand. The market's interpretation of that message, bullish or bearish, is what sends mortgage rates soaring or tumbling in the aftermath. So, what does this mean for you, the person just trying to get a mortgage? It means you need to get a calendar. Not a regular calendar, an economic calendar. You can find one on any major financial news website. Your job is to circle 3 dates every month: CPI Day, Jobs Day, and, for the 8 times a year it happens, FOMC Day. These are your red flag days. These are the days you do not want to be caught floating your interest rate without a plan. The days leading up to these reports are often eerily calm. The market is in a holding pattern, waiting for the new data. This is the calm before the storm. It might be tempting to think, oh, rates are stable, I'll just wait and see what happens. That is a massive gamble. It's like standing on a beach, seeing the water recede unnaturally far out, and deciding to go for a swim. A tsunami is coming. On the day of the report at 8:30 a.m. for CPI and jobs, or 2 p.m. for the FOMC, the data hits and the wave crashes. In the first hour after a major report, the market is pure chaos. Lenders might pull their rate sheets entirely. They might issue multiple reprices throughout the day, where the cost of the same rate changes dramatically. Trying to make a locking decision in this window is like trying to catch a falling knife in the middle of an earthquake. It's a fool's errand. The smart move is to have your strategy in place before the report hits. You either lock in the relative safety beforehand, accepting the rate you have, or you commit to floating and accepting the full risk of whatever the report delivers, knowing you'll have to wait for the dust to settle before making a move. These 3 events are the pillars of the short-term mortgage rate market. They are the scheduled seismic events that reshape the landscape every single month. By knowing when they are and what they represent, you are no longer a passive victim of the market's whims. You are an informed participant. You can see the storm clouds gathering on the horizon long before the rain starts to fall. You've now learned about the bond market that sets the price, the Federal Reserve that steers the ship, and now the economic calendar that schedules the storms. We have all the pieces on the board. We understand the rules of the game and the psychology of the players. But there's one final critical step. How do you take all of this knowledge and forge it into a weapon? How do you synthesize the data, the charts, and the news into a single coherent strategy to make the perfect locking decision for you? That process is what I call the rate lock decision matrix. It's a 3-level framework, a pyramid you build in your mind that filters out the noise and focuses you on what truly matters. It synthesizes everything we've talked about into a simple, repeatable process for making the right call at the right time. At the very base of this pyramid, the wide, unshakable foundation, is the most important element, and it has absolutely nothing to do with the bond market, the Federal Reserve, or the Consumer Price Index. The foundation is you. It's your personal financial reality. Before you even glance at a chart, you have to answer 3 brutally honest questions. First, what is your genuine risk tolerance? This isn't about what you think it should be, or what some guru on TV says. It's about how you're wired. If the thought of your mortgage rate ticking up by 0.1%, just a tiny fraction, is going to make you lose sleep, stare at the ceiling at 3 a.m., and stress eat a pint of ice cream, then you have a low risk tolerance. And that is perfectly okay. If, on the other hand, you see a bit of market volatility as an opportunity, and you're comfortable with the idea that you might lose a little for the chance to gain a little, then your risk tolerance is higher. There is no right or wrong answer, but lying to yourself here is the fastest way to make a terrible decision. Be honest. Second, what is your financial runway? How much of a buffer do you have in your monthly budget? Let's get specific. If you lock a rate today at 7%, your principal and interest payment is, say, $2,000 a month. If you float and rates jump to 7.25%, that payment might become $2,050. Does that $50 break your budget? Does it cause genuine financial strain? Or is it an annoyance you can easily absorb? Your ability to withstand a small increase in your monthly payment dictates how much risk you can afford to take. A tight budget demands a conservative, lock-it-in approach. A comfortable buffer gives you the luxury of being more strategic. And the third, most critical question for your foundation: what is your sleep at night rate? You need to calculate this number right now. It's the absolute highest interest rate you could lock in and still feel genuinely good about buying your home. It's the rate where the monthly payment is perfectly manageable, where you don't feel stretched, and where the joy of owning the home still far outweighs the cost of the mortgage. This number is your ultimate safety net. It's your line in the sand. If the market ever offers you a rate at or below your sleep at night number, it's an incredibly powerful signal to lock it in and never look back. Getting greedy and floating past this point is how people turn a winning position into a losing one. Once you have that personal foundation built, you know your risk tolerance, your budget flexibility, and your sleep at night rate. Only then can you move to the second level of the pyramid, market context. This is where you apply all the external knowledge we've been dissecting. You start with the macroeconomic winds. What's the big, overarching story? Is the Federal Reserve in a rate hiking cycle, constantly talking about fighting inflation? That's a strong headwind, pushing rates higher over time. Or are they signaling cuts? Is the economy showing signs of slowing down, with jobless claims rising and manufacturing output falling? That's a tailwind, creating an environment where rates are more likely to fall. You don't need to be an economist, you just need to know the general direction of the wind. A strong headwind should give you a bias towards locking sooner. A strong tailwind might justify the risk of floating. Next, you zoom in with your technical analysis. You pull up that mortgage-backed securities chart. Where are we in the current channel? Are we bouncing off a strong floor of support? Remember, for MBS, a floor of support is a ceiling for interest rates. Hitting that ceiling is a 5-alarm fire drill to call your lender and lock. Conversely, have we just broken through a ceiling of resistance? That suggests there's more room for prices to rise, meaning more room for rates to fall, and could be a reason to consider floating. You're using the charts not to predict the future, but to understand the immediate risks and opportunities. Is the path of least resistance for rates higher or lower today? Finally, you check for news catalysts. You look at the economic calendar for the week. Is there a major inflation report, a CPI or PCE release, coming out tomorrow morning? Is the Fed chair scheduled to give a speech? These events are landmines. They can blow up the market in an instant. Floating your rate into a major, known economic release is not a strategy. It's a coin flip. It's a pure gamble. The prudent strategy, especially if you have a good rate on the table, is often to lock in before the data drops. Take the risk off the table. The worst-case scenario is that the news is great for rates, and you miss out on a slight improvement. The best-case scenario is that the news is terrible, rates skyrocket, and you look like a genius for locking. Now you have your foundation and you have your market context. You're ready for the peak of the pyramid, the daily execution. This is where it all comes together in a simple, actionable decision. Every single morning you perform a quick 3-step check-in. First, you check your foundation. Has anything changed for me personally? Is my closing date the same? Am I still comfortable with my sleep at night rate? Second, you check the market. What's the macro wind doing? Where are we on the charts? Is there a news landmine today? And third, you check the offer. What exact rate is my lender offering me right now? With those 3 pieces of information, you can use a simple, if-then framework to make your decision. If the rate my lender is offering is at or below my personal sleep at night rate, and the market context is bearish or uncertain, meaning the winds are blowing rates higher or a big news event is looming, then I lock. Immediately. I don't hesitate. I don't get greedy. I take the guaranteed win that aligns perfectly with my personal financial plan, and I eliminate the single biggest source of stress in the home buying process. If the rate offered is pretty good but not life-changing and the market context is clearly bullish, the winds are at my back, the charts look positive, and the calendar is clear, then I can make the conscious, informed decision to float for another day. I am accepting a calculated risk for a potential reward, and I will repeat this entire process again tomorrow morning. If the market makes a sudden, dramatic move in my favor, a massive green candle appears on the MBS chart after some positive news, then I don't wait for my lender's official daily rate sheet. I call them on the phone right then and there and ask to lock. These windows of opportunity, these reprices for the better, can be fleeting. They can open and close within hours. You have to be proactive. Let's make this real with 2 quick stories. Meet Sarah. She's closing in 30 days. After doing the math, she knows her sleep at night rate is 6.875%. Today, her lender is offering her 6.75%. She looks at the market context. The last inflation report was hot, the Fed is talking tough, and MBS prices are sitting precariously on a support level. For Sarah, this is a no-brainer. The offer is better than her personal target, and the market risk is high. She locks her rate, feels a wave of relief, and can now focus on packing boxes. She didn't get the absolute bottom of the market, but she got the perfect rate for her, and that's a massive win. Now meet Mike. He's also closing in 30 days and is being offered the same 6.75%. But Mike has a high risk tolerance and a 6-month emergency fund. His sleep at night rate is 7.25%. He looks at the same market context and sees the risk, but he also knows that a key jobs report is due at the end of the week, and he has a hunch it will be weaker than expected, which would be great for rates. Mike decides to float. He is making an informed gamble, fully aware that he might lose and rates could go up, but he's financially and emotionally prepared for that outcome. He has a different foundation than Sarah, so he makes a different decision. Neither Sarah nor Mike is wrong. They both use the same framework to arrive at a decision that was right for their unique situation. And that is the ultimate secret. This isn't about predicting the future. It's about controlling your own. It's about shifting your mindset from a passive passenger, helplessly watching rates go up and down, to an active, informed pilot who has a flight plan, understands the weather, and knows exactly when to land the plane. The goal is not to time the market perfectly and snag the lowest rate of the decade. The goal is to secure a great rate that fits your personal financial plan, allowing you to buy the home you love with confidence and peace of mind. By building your pyramid, understanding yourself first, then the market, then executing with discipline, you remove the guesswork and the anxiety. You replace fear with a strategy. You take all this data, all this news, all this complexity, and you forge it into a tool that serves you. You've put in the time to understand how this all works. You are now more informed than 99% of homebuyers out there. You have the framework. Now go make the best decision for your future.